Welcome back to Kitco News. I'm Jeremy Szafron. Well, investors are still digesting Monday's market swings when Treasuries took a sharp hit, this time on renewed fears over the U.S. fiscal outlook. Now, the trigger? Well, Moody's downgraded the U.S. credit rating late on Friday just before the markets closed, citing surging deficits and rising debt costs. And that move is now fueling anxiety ahead of key tax cut bill heading for a critical vote in Congress this week. And at the same time, well, gold just posted its strongest quarter since 2016. Now, according to the World Gold Council, total demand hit 1,206 tons. But what stands out here is where that demand came from and what it reveals about investor behavior. Gold ETFs saw a sharp reversal. 226 tons flowed in. Now, that's the most since Q1 of 2022. And central banks, well, they keep buying, led by Poland and China, and retail investors in Asia. They kept stacking bars and coins even as record prices dragged jewelry demand to new 5-year lows. But the European Central Bank's latest financial stability review adds a new layer here. The ECB says that gold's surge reflects a short covering, rally in ETFs, and a shift towards physically settled futures contracts, a sign again that investors are bracing for prolonged policy uncertainty, trade disruption, and of course, geopolitical stress. Joining us to unpack it all is Joseph Cavatoni, is a senior market strategist at the World Gold Council. We'll talk about the data. Let's talk about the psychology driving these flows. Great to see you, Joe. Welcome back.
Great to be here. Thanks for having me.
Okay, we got lots to get into, but let's start with this latest report from the World Gold Council. It shows that the total gold demand, including OTC and stock flows, held firm at 1,206 tons in Q1. That's the strongest start to a year since 2016, as I mentioned off the top. What stood out for you here, Joe? I mean, what was the most interesting in this data set? Was there anything that surprised you?
Well, I think you hit the nail on the head with two things that really do stand out. And that is that central banks continue to be at the table, and we don't expect to see that slowing down in a major way at any time over the course of 2025. But the second point you highlighted, which is investors and global investors at that, back to the game with respect to adding gold and allocations to their portfolios. We saw that with both ETFs and also the OTC demand for gold in terms of physical ownership of gold. So North American investors, Asian investors in particular, you go a little bit beyond the first quarter report that we've published, you could see levels and flows in markets like China, which we've talked about before being a big investment market that's growing. Record levels in that market for the month of April alone, more flows into China in April in ETFs than we saw in first quarter in terms of a flow in North America. So really exciting and interesting. And again, those two big components of the use cases at the table. Not a big surprise that jewelry was a little bit off as usual. And then pleasant to hear that the technology use holding firm at about 10%.
Yeah. And of course, we see these gold in the headlines continuously. And I mean, it's interesting because that headline demand, some people would say it looks strong only because of this volatile stock flow and the OTC volumes. And we know that can swing quarter to quarter. But if we strip that out, I mean, is the picture still as robust?
I think that the picture is getting more clear and more robust for gold as an investment. Now, what I mean by that is that you talked about the fact that we've got debt levels that are unsustainable in the U.S., and that's actually being dealt with by the current administration. But it is going to be a painful process, and it's going to be very challenging for the administration to find a way to tackle it. And actually, Moody's actions on Friday night, the third of the three agencies to downgrade the U.S. finally, have actually spoken about the fact that it's probably something that people need to pay much closer attention to. That means dollar assets and the dollar itself under further pressure, and actually only continuing to create more risk on the horizon. So the investor outlook, that's more challenging, more difficult for them to ascertain the difference between what bonds and equities are going to perform like. And I think that they're realizing diversification, potentially hedging against ongoing sticky inflation, hitting that outcome of what we're going to see, whether it's recession, stagflation. It's all still very challenging. And I think people are realizing it's time for gold. And actually the allocations are coming in again across the board, North America, Europe, and Asia in first quarter. And actually now we're looking into the rest of the year. Still look very difficult for people to get a picture on how things are going to play out.
Yeah, it's interesting. Okay, I want to talk about Moody's. Before we get into that, though, one of the headline shifts that was sharp was this rebound in gold ETF flows. I mean, 226 tons came in, reversing the persistent outflows that we saw back last year in 2024. It's a pretty major turnaround. And what it's interesting is that it was led by U.S. listed funds, and then there was that surge in Asia, particularly in April. And as we mentioned off the top, this European Central Bank, I mean, it's flagged that this is a possible short covering rally in its latest financial stability review. And a lot of people are talking about it. I'm curious, what changed in investor behavior here? Was it this purely price momentum based, or was it the institutional players rethinking allocation?
I think it's time for the rethinking of allocation. Now, if you think about what's played out with exchange traded funds as a lens into the market for the last couple of years, while we saw net outflows, the appreciating price of gold actually kept allocations about a consistent level in terms of the last few years. So people weren't unwinding their gold positions in wholesale ways. What they were doing was probably holding more risk in their portfolio and less risk diversification in the form of gold in their portfolio. And I think what's happening at this point is people are realizing I need that diversification because correlations between bonds and equities are as high as they've ever been. And actually, when you're looking for the diversification benefits, it's what gold stands out with. And actually, at this point, you're seeing U.S. investors, you're seeing Asian investors, to a lesser extent, European investors, finding more room for allocations to gold. So while it is potentially looking short-term in nature, I think it's a shift in terms of the mindset, particularly with the questions around the strength of the dollar going forward. People are starting to realize that, hey, maybe we should be looking at a bit more diversification. And I think that that's what's driving it. Now, these ETF flows are just, again, a lens into about 7%, 8% of the total investment market worldwide. So the physical market's still a very robust market. But again, what you're seeing is a shift in North America, adding gold to the portfolio.
Okay, interesting. And we got to get back to, the ECB flagged this notable shift towards physically settled gold contracts, particularly on COMEX, tied to policy and trade uncertainty. Are you seeing this trend in your data? What does it tell you, about the investor confidence in the broader financial system you were just talking about here?
So we had an opportunity to review the ECB document. It's a well-written piece, and it's actually very informative for sure. And actually, what we would encourage people to do is to refer to our research, where we highlight a couple of key points that historically point to the performance of gold in very much the scenario that the ECB is talking about. So if you look at the systemic events that have happened over the last, let's call it 20 years, whether it's the dot-com bubble, the global financial crisis, long-term capitals meltdown, whatever those moments are that you think are material enough to signal a systemic type of event that I think the ECB is referring to in their document. What we can see from the history is that gold's performance, that diversification performance, and our data speaks to this, is actually where you want to be. So you see risk assets selling off, gold holding its value, and the 6 months subsequent to that point in time when you have that moment, the performance of gold is up, I think it's in the range of 2 to 3% post one of those moments. So it actually has historical relevance for us to take a look back and say, hey, what does it do when you have a moment of systemic event like the ECB is referring to, and understand that its performance is strong, it's holding its value, and actually post the event, it's actually a safe haven that people continue to flock to. I think the document in the write-up is very good, but again, it's focusing on a few elements of the gold market, and we would also encourage people to understand gold is a global asset, and the market for liquidity is $150+ billion a day. So it's very liquid, and I think that data with the ECB document give people a more wholesome and complete picture of saying, okay, so there are some challenges, there are some risks, but ultimately we think gold's performance in those types of environments will be strong, and history has shown it.
Yeah, I'm curious, we were talking about those flows before. Are they sticky? What would you watch for as a potential reversal signal? Would it be, say, another 3-month streak of outflows?
Well, I think that the stickiness to the flows, what you can determine from the flows in particular in ETF land, is that there are certain instruments that are very liquid and very much like capital markets instruments. The Spider Gold Shares GLD, for example, has the largest open interest in options in the market. And that's used by most market participants, including investors, but also those that are speculating. Those flows tend to be a little bit more volatile, and you can actually see a little bit of like the direction the speculators are going into. All the other instruments are more along buying and holding in terms of the investor outlook. So what I'd say is that what we're seeing through the flows is a lot of the action being with the stickier investor flow. And actually, I think it's actually increasing holdings and people are holding on to things. Right now, we keep holding firm at around a 3,200 level. And that just gives us confidence that people are buying and holding. And actually, there's no rush to the door to get out. And the signals looking forward as to what would lead to investors exiting gold, there'd have to be some pretty remarkable events taking place around global trade, geopolitical tensions, dealing with the debt limit, the debt ceiling, dealing with the sustainability of that, and also just really kind of watching the world make a remarkable twist of fate in terms of where it is today to where it could be tomorrow. And there's a lot of that is pretty much it's a pretty big challenge for us to see that kind of an environment develop.
Yeah, no, I get that. Let's shift over to central bank demand. I mean, we continue to talk about it. It continues to be a main key driver here. The report shows 244 tons added to official reserves in Q1. Poland led, by the way. It's pretty interesting. I mean, China extended its buying streak to 6 consecutive months. I mean, how do you interpret this? Are central banks responding to inflation and geopolitical fragmentation, de-dollarization, or are they just rebalancing after the dollar's strength in 2022 and in 2023?
Yes, and yes. I guess what I would say to what your point is, Jeremy, and we love to refer back to our annual survey with central banks, which gives us a lot of intel, 70 central banks on a global scale. We're about to release our new report next month. Keep an eye out for that. But what they've been signaling to us has been a couple of key factors. They're concerned about homegrown inflation on their own countryside. They're looking at diversification with a liquid asset that they could have in a reserve portfolio. Gold plays that role completely. They're continuing to focus on whether or not they have access to the right kind of risk asset when they need it, when they need to support their local economy. And they're also in the midst of actually looking and feeling like dollar risk assets, dependency on the dollar, dependency on the euro. These are things that they've said over 5 years they would be moving away from. Now, we're not talking about dropping the dollar as a settlement currency or de-dollarization or a problem. Diversification away from it. Too much reliance on it, too much reliance on dollar assets. And they're looking at that diversification and gold being global and actually something you could store not only in the Bank of England, where you can make use of all the different features that come along with being in that liquid market, lending it, getting a return on it, or actually holding it on the home front. It's all very much in the mindset of what a good reserve manager would want from an asset in their portfolio right now.
Speaking of reserve managers, do you see an upper limit of how much gold that they're willing to hold? I mean, is there a modeled ceiling for central bank gold allocations?
It's a good question, and a question we get asked a lot. I think what's right to point out is that on average, the emerging market central banks, which is where we're seeing the most buying and have over the last 14, 15 years, those banks tend to hold less than 10 to 15% of their reserves in gold, whereas in a developed market, for example, the U.S., it's closer to about 75 to 80% of the reserves. So if you just look at it in that context, there's definitely room for growth. And I think that there's definitely room for addition of gold into the portfolio. And I think that at this stage, you've got all these different working examples where, whether it's Turkey or Poland, making use of gold in terms of how they're managing their reserves or adding to their reserves. The case is strong for them to continue to be at the table. Again, having signaled less reliance on not only the dollar, but the euro as a reserve asset going forward.
Yeah. Okay. We got to turn over to retail investment. I mean, bars and gold coins saw 325 tons of demand globally. That's pretty impressive given how prices have been so high here at these levels. China, India, both posted gains. I'm curious, if we're seeing a generational shift in how retail investors view gold as wealth preservation tool, particularly in Asia. I mean, are there still untapped markets with growth potential on the retail side?
Oh, I think completely. I think what's actually really exciting about gold and what's actually been really clear in the report is that while we're not seeing a demise of the coin and bar market, quite the opposite in China and India, you see that sophisticated portfolio allocations are coming together and using ETFs as well. So I think what you're seeing is an affinity for gold in markets like China, India, and actually growth in terms of demand from those markets, not only in the physical sense, but also in the financial instrument sense. So you're actually seeing a shift that's actually pretty exciting. Now, on a global scale, the Western markets tend to be a little more quiet in terms of the OTC activity that they might be doing in terms of investment. And the bar and coin markets have seen a little bit of a slowdown. But I think that that's actually just reflective of the type of person and clientele that might be making the moves to buy bar and coin, where they're looking at it in more of a risky concern around the political landscape, for example, in the U.S. But again, it's nothing to be alarmed by. I think it's more along the lines of the prices are high, as you've said. Some of the Western markets might mean that people are a little less inclined to buy. But I think over time, as we get this price embedded into the ecosystem, people will start getting back to the game and looking at gold again in the physical form.
We talk about that psychology all the time. I mean, how much of this demand is truly discretionary wealth preservation? I mean, how much can be driven by kind of lack of trust in their local banking systems? Or, I mean, we're seeing this currency pressure in emerging markets too.
I think it's all of the above. And I know that's not the best way to answer the question, but I think people are actually concerned about their wealth, their preservation of wealth. I think we've all lived through the global financial crisis when many people saw portfolios drop pretty dramatically. And I ultimately think that hasn't left the mindset of many people. And many people of a generation that still, are working very hard to kind of bring, their wealth to the highest levels they possibly can. I think it's ultimately an asset that's well understood, probably a longer, better understood asset in markets like Asia. But not something that the Europeans and the Americans, in Western markets, Canadians, people get it. They just understand that this is something that you can actually have in your portfolio. And when you're losing your buying power through depreciating currency, having gold as a component of your portfolio helps you out quite a bit.
Yeah. On the other side of the ledger here, we saw a 21% year-on-year drop in jewelry demand, especially in India and China, which fell to 5-year lows in Q1. And we keep seeing that B-roll, a lot of people lining up in these markets to buy gold. I'm curious, is this just price fatigue, or could it start, to affect another segment of the market?
I think that market in particular, jewelry is actually a very price sensitive market because even though it can be a form of savings in many of the markets like China and India, what it is a consumable good. And actually what's encouraging to see is that you're not only seeing the slowdown that you would expect from jewelry, not only from the fabricators who would take inventories and have things sitting on a shelf, but also the end consumer. You also are seeing that on the flip side, the money's moving from maybe jewelry, where it looked to be kind of a form of savings, but with a little bit more panache to it. But then you now see it coming into the form of investment. So investments moving forward and growing in both those markets. Jewelry is obviously slowing down. I think with jewelry, what we have to be patient on is let the price bed in a bit. Let people understand that this is the new norm for the gold level. And ultimately, the fabricators will find ways to get gold into the hands of people in sizes and shapes that actually work at the new price points.
Yeah. And speaking of that supply too, I mean, mine production hit a Q1 record at 856 tons. But interestingly, recycling fell a little bit slightly despite these record prices. What's holding the secondary supply back? I mean, are consumers holding out for even higher prices, or is there more of a structural constraint limiting how much recycled gold they can return?
Great quarter for mining. And actually, we expect to continue to see that strong performance on that part of the market. But I think what the signal is that we take from the recycling side of things is that maybe the recyclers are sitting back and saying, hey, it's not necessarily the right time to go ahead and cash in on this. Let's sit back and wait. That's the signal to us that maybe the price appreciation expected from the recycling community is on the upside.
Yeah, interesting. Okay, let's zoom out a little bit to the macro picture, because in your report, you highlight elevated stock to bond correlations and obviously this rising stagflation risk that we continue to see. And now we have this renewed U.S. fiscal concern, this looming tax bill, Fed rate cut speculation, what's going to happen there with the Fed. And of course, these trade tensions continue to kind of escalate. How do you interpret this backdrop supporting or potentially threatening the gold rally going forward?
I think it's pretty simple. I think risk assets, and we've been signaling this for a while, have been frothy, probably a bit overvalued, and you're going to have increased levels of volatility, increased levels of correlation between bonds and equities. And actually, that's why we think gold's actually very much in the discussion with the investor community right now. Mm-hmm. The challenges that are ahead of us are just so significant. and not going to be easy to tackle. And we're getting reprieves in the form of announced tariffs, pauses on those tariffs, but then 90 days will come and 90 days will go, and we'll have to be right back at the negotiating table. And there are so many tables that need to be dealt with in terms of the negotiations. It's just very hard for us to see how things are going to be very quickly dealt with, and risk and uncertainty is going to be lowered in any meaningful way. And I think Moody spoke to that with their actions in terms of the downgrade. The challenges around the debt limit, not only in the US, but around the globe, it's a pretty challenging environment right now. So you got to make sure that you have the right kind of perspective in terms of managing that risk. And I again point back to those drawdown moments that we talked about earlier in relation to the ECB's view. If you think about what gold does during systemic events of that nature, if we're headed to one of those, or actually just having the diversification in your portfolio can only help.
Yeah, Joe, I mean, we've seen gold being in this uncharted territory for most of the year. So I've certainly talked about a lot of record high prices. Are we in, full price discovery mode now, or do your models suggest maybe a technical or a macro ceiling for gold in the second half? Basically, I'm asking you, what's next here? Are we going to 4,000 like we talked about?
Well, I think the right way for us to give people perspective on this is to understand the use cases. Again, 3 of the 4, investment, central banks, and technology, are all doing really well. Consumption is up, and the expectation is that those numbers should continue to do well in terms of performance for demand. The jewelry market is one that we've talked about, probably continuing to be flat to down, languishing for a bit until people understand the price levels. So with those 3 use cases on in the U.S., in the globalist scheme of things, you're going to basically see the global gold market continuing to have price appreciation. And actually, the numbers that you're hearing from some of the analysts in the market, 3,500, maybe even talking the 4,000 number, I think those are all reasonable numbers to take into consideration, even with what we've seen so far year to date, which is a near 25% return on gold through today as we speak. The numbers could be high, the numbers could be strong, and I think the case remains very strong for those use cases to continue to add gold.
Yeah, so we were talking. You and I were talking before coming to air. I just came back from South Dakota. Obviously, gold, very topical there. A lot of people talking about it. You're on the road a lot. You have an upcoming trip to D.C. or even maybe a couple. I'm curious. I mean, this is your field. What is the discussion about gold in D.C. particularly? I mean, we have this new strategic metal bill. Things have changed a little bit, I'm sure. What are you hearing?
Well, there's open legislation that we've worked to support that talks to the fact that we want to remove an impediment for mutual funds to own gold. So that's actually a bill that's actually outstanding right now. That's actually looking to be included in tax legislation that could come to us very quickly, which is super exciting. And again, what it does is it takes the precious metals basket of gold, silver, platinum, and palladium, and it turns it into a good income construct and offers that for 40 Act mutual funds to actually go ahead and invest, which today, if they were to do that, they would have a punitive tax treatment on buying in any commodity. So that's actually pretty exciting. But we're also talking around different aspects of the market, whether it's with a strategic initiative in mind from the U.S. government's perspective. While not a critical mineral, it's an element, it's an actual commodity that's very important, and the U.S. government understands that completely. So whether it's dealing with some of the challenges around artisanal mining on a global scale, or looking at ways to actually increase the overall process and speed with which permitting takes place. All these topics are very much top of mind and actually very much in the discussion right now. Yeah. And that, whether it's tax, whether it's removing impediments, whether it's actually helping people understand the gold market, very much in the minds of the government today.
Yeah, exciting time for you, my friend. Joe Cavatoni, Senior Market Strategist at the World Gold Council. Always a pleasure having you on the show. Thanks for this.
Great to be here. Thank you.
I appreciate it. I'm Jeremy Szafron. For all of us here at Kitco News, be sure to hit the subscribe button. We're going to have some great content coming up all week long. We'll see you next time.